Hello everybody, Charlie Gipley here with CG Finance Group. What you're looking at here is the WinFlex interface. Now within Business Builder, if you click on Sales Tools on the left-hand side and then Life Insurance and then go down to WinFlex, that's where we're at today. And what I want to show you is how to run an indexed universal life insurance illustration. Specifically, we'll run one of my favorites, which is Allianz. Now, I won't go into what Business Builder is, but as you know, that's a repository for many things, for front-end sales stuff, as well as the back-end kind of case, pending cases, issued cases, place cases, all that good stuff. But that's for another day, another time. Let's get into the illustration here. So this is WinFlex, which again, sales tools, then life insurance, then WinFlex. And this is where all the respective insurance companies, illustration software is at, and it just timed me out was all. So you go over here to illustrations, and by the way, once you go to illustrations, you will see which carriers have you approved, because obviously all these carriers that feed through to WinFlex, their illustrations, they're not going to approve you. Most of them won't if you're not appointed with them. So if you do not have a particular carrier where it's like, whoa, you know, I'm appointed with American National, but I don't see them up here. Obviously, they are up here for me. Then what you can do is you can go over to your profile on the upper right-hand side there, and then you can add companies if you like. And then what happens is, you know, you get your agent code, you click the company that you want to illustrate, and then you hit place request, and then the insurance company will get a feed from WinFlex asking for your permission to have the software here. And eventually they'll grant it, assuming you are in fact appointed with them. So anyway, if you don't have the carriers there, that's how you do it. Upper right-hand side, your profile, and then request company. So let's go into kind of a typical IUL illustration, which, you know, 80% of the time is a cash accumulation focused product. So across the top here is kind of the control panel, so to speak. You know, you click across, you start from left and you go to right. Very basic stuff, valued client, male. Let's try the typical 45-year-old male. That's kind of the typical IUL purchaser. Let's see, go down to, I'm in Iowa, so I'll click Iowa here. You know, date of birth is always better, because some of these carriers, most of these carriers go off age nearest, not necessarily age last. You know, my birthday is December 11th, you know, and December 11th, I'm 42, and what is it? It's May now. Actually, I'm right on the borderline. You know, if it were August or something like that, technically I would be underwritten like I'm 43, even though I'm only 42. Why? Because my birthday is age nearest. Or why? Because if that carrier goes off age nearest, then I'd be age 43. But anyway, so date of birth is always better. Nonetheless, let's just stick with our 45-year-old here. Standard non-tobacco, that's self-explanatory. Some companies have juvenile policies, some do not. Just so you know, many times the life insurance requirement for juveniles is that the parents have to have at least twice what the juvenile has in life insurance coverage. Twice what the juvenile is requesting, I should say, in life insurance coverage. So just know that, you know, a lot of people are like, well, the parents aren't healthy, let's do it on a juvenile here, because that juvenile is healthy and that'll be a great way to accumulate cash. Well, just be cognizant of that restriction. You know, a lot of times the way that these cases look is, you know, we want to maximum fund this policy, which means we want to solve for a face amount. And what is that face amount? That face amount should be the absolute minimum face amount. Why is that? Because the lower the face amount, the lower the cost of insurance charges are, right? So if you are solving for what that low face amount is because you have a premium in mind, what I just did there is exactly what you do. The solve for is face amount, and usually the face solve option, 90% of the time it's minimum face max accumulation. Now, not all carriers have that, by the way. Some carriers, it may be guideline annual premium instead of minimum face max accumulation. And when basically the minimum face max accumulation will be either the 7-pay face amount or the guideline annual face amount, just depending on how old the client is and what the premium amount is going in. But some carriers don't have it this simple like Allianz does. Some carriers may just have the 7-pay or the guideline annual premium. Most of the time it's guideline annual premium. Of the two of these, 7-pay or guideline annual, most of the time it's guideline annual. Otherwise, if you have a big chunk you're cramming in within a 4-pay, 5-pay, 6-pay, 7-pay, that's usually the one that you're going to solve for. But for Allianz, they make it simple. Hey, whatever one of those two it needs to be, just click here and we'll figure it out, is what Allianz is basically saying here with their illustration. Premium deposit fund, that's if a client has a lump sum and they want to siphon that lump sum off, say over a 5-pay, 6-pay, 7-pay into a policy. Why would they want to do that? So it's spread out, so it's not a modified endowment contract. Not going to go into that a whole lot today. I usually don't put anything in that premium. I just skip right to the calendar, right to the schedule. Let's say our 45-year-old wants to pay premiums until age 65. For some reason, this is always a year behind. I think it's a beginning of year, end of year thing, but premium to age 65, I'll put 45 to 64. And let's say 500 a month. Let's put 500 a month there, right? Now, it basically makes you fill in the gaps. So, between 65 and max being age 121, you want to put 0. Otherwise, if you don't have that, it will just assume you're paying premium from age 45 to max. So it's almost like you do have to fill in the gaps. Then this stuff down here, not required for now on this IUL cash accumulation illustration. If we were getting into no lapse, GUL and stuff like that, that's where the bottom would really come in. Now remember, we hit $500. What is that? Is that annually? Is it monthly? It's over here so you kind of skip a tab, right? You go into policy options. It's a weird place for it, I think. And you put that on monthly, the premium mode as monthly. All right, let's go back to disbursements. Many times, the disbursements that a client wants look something like this. Okay, so 45 to, remember, 64, we have to fill in the gaps, remember? So that's 0. And then 65, but it's a year, for some reason it's always a year behind what I'm showing here, which technically means 66. I hope this makes sense. But 66 to age, 85 or 90 is usually what people say. So let's put 84, that'll take us to age 85, and then solve for max. So what that does is it says, okay, so for our client to take loans against the policy, what is the maximum amount they could take over that 20-year period of time without the policy exploding? Because we don't want the policy to explode for obvious reasons, right? We don't want it to lapse, because a policy that lapses, if the policy lapses before the consumer lapses, so to speak, that was not a life insurance policy from a tax standpoint. So that means bad things happen. That means if they took loan amount outs above and beyond the premium they put in, they're going to get a tax liability. Basically, a policy that lapses before the consumer lapses, it's taxed like an annuity. And with an annuity, everything above and beyond the cost basis that was taken out of the policy, whether it was a loan or not, the client gets a tax bill, a tax bill based off of the retroactive, income that they took above and beyond the basis, what they put in. So solve for max. This basically says taking it down to as slim as we can so that the policy between age 85 and 121, so it's able to not lapse, right? So what's a disbursement option? Loans, 90% of the policies I would say I run, maybe 95 are loans. Why? Because the IULs that I like have great loan provisions to where if you do withdrawals of basis and then switch over to loans after that, it just doesn't work as well, because a withdrawal is basically a wash without going into details. But with the loans, especially with a 5% guaranteed forever loan that Allianz has, it just works out better with loans immediately. So that's what I always go with. And then loan allocation. Index loan. I like the index loan the best, again, because of the way that it's designed. So most of the time, this is already filled in. No need to even worry about that down here most of the time. So go over to policy options. Now, because of other videos that we have, I have another video that talks about the difference between increasing death benefit and level death benefit. That's really this section. Do you want increasing? Do you want level death benefit? Well, first of all, the insurance test. You know, this is very Congress-y, very legislation-y type stuff. But 90% of the time, heck, maybe even 99% of the time, guideline premium test is a test that you want. Just keep that as it is. Now, for cash accumulation purposes, most of the time what you're going to choose is an increasing death benefit, switching over to level in the optimal year. What does that increasing death benefit switching to level do? It minimizes the cost of insurance charges. Again, I have another video on that, on why that is, but you want increasing death benefit. How long? You know, when does it switch over to a level death benefit? The answer to that question is in the optimal year. When is the optimal year? The answer to that question is usually at the end of your premium payment stream, right? So, and then what you have here is the end of your premium payment, if you remember, was age 65. And then from that point on, it's a level death benefit going forward. And you are good to go with that. Indexed accounts, I have my favorites. You know, that's really just where you choose the index accounts. And basically by choosing these, it says, okay, what will my illustrated rate be in the policy here? Well, the answer to that question is 6.9 based off of, you know, what the allocation was that I chose here. Policy riders, this is where you can choose a child term rider if you want. The loan protection rider is already on there. What that is, that's a topic for another time. Chronic illness rider here. Most of those are automatic, the chronic illness riders. Output options, this is where you can have kind of some ancillary, some supplementary printouts where you choose, hey, you know what, I want to talk about the internal rate of return on the death benefit and cash value. You can click that. Some of these are just basic. You pretty much should have them, so thus they're already pre-checked. Agent info, you have me from my days at Genworth. For some reason, that has never changed. You know, I should probably update that. There, I updated that. Anyway, so Charlie Gipple, CG Financial Group, you know, that's me. But obviously when I run it for you guys and gals, I just click that button, I search for you, and good to go. And then there's some other conceptual type stuff. I hit calculate here, and what happens is it takes a couple seconds, and you will see things like the target premium, what the death benefit is, because remember we solved for that minimum death benefit. So it'll show you a quick snapshot here. Then we click over to the actual PDF. So yeah, so male 45, standard non-tobacco, $138,000 is the minimum premium based off $6,000. Again, remember $500 a month. The target premium, which the only thing target premium is, a lot of people are like, what's target mean? Is that how long it takes to carry the policy, or is that the premium amount to carry the policy forever? Forget all that. All that the target is it's just a mechanism for calculating your commission. So with a lot of products, it's 70, 80, 90, whatever percent of target premium, and then the excess above and beyond that, which $6,000 in the first year, right? So you have roughly $2,300 that's target premium. And let's say you get paid 90% of that. Let's just round up and say 100%. So you get paid $2,300, right? Because, you know, in that first year, you're paying at least $2,300. But then on top of that, there's $3,700 that's excess. You know, and that excess may be paid out to the tune of 2.5% or 2%. I don't remember exactly what excess pays with Allianz on the excess. So you get $2,300 roughly, because that's the target, assuming my 100%. But then in addition to that, $4,000 or $3,700 times 2.5%, whatever that comes up to, and that is your total commission in that first year, assuming that premium is paid, you know, those 12 months premium is paid. So anyway, you go over here, and this is what you have. Really the meat of the presentation, so to speak, usually starts, at least with Allianz, on page 4 here. How do you know that it ran the illustration correctly? Well, my first telltale sign is, that it shows an increasing death benefit. That death benefit is in fact increasing like we asked for it. It shows a premium going in, again, starting at 46 and then spanning to age 65. And then remember how we wanted income, i.e. loans, to kick in at that point in time. And those loans went from age 66, or we put into the illustration system 65. Again, I think it's an end of year, beginning of year thing that the system goes off of. And that runs until age 85. So, what we've illustrated here is that $6,000 going in over 20 years, that is a seed of $120,000. And that is an after-tax seed. Mrs. Client, with that after-tax seed, what if I told you that the harvest that you could potentially take out by the time you are 85 years of age is $537,000. Actually, this is Mr. Client, not Mrs. Client, right? Is $537,000. The seed was after tax. That's a total premium you put in. The income is not taxed at all, so you're paying taxes on the seed, but not the harvest. And traditional IRAs, for instance, you're paying taxes on the harvest, but not the seed, right? So $537,000 in value on a $120,000 premium, not bad, right? But you're still not done, because should you pass away at age 85, roughly one's life expectancy for a 45-year-old. Actually, 45-year-old's probably going to die a little earlier than that. You're not done. Yes, you've gotten $537,000 tax-free via loans, but then in addition to that, the beneficiary, based off this projection, will get $129,000. So $129,000 plus $537,000, what is that? That's like $660,000 or so off $120,000 premium. All of that was tax-free. So that's really how you illustrate index universal life insurance on this. And then what you can do is you could go back up to the top, click back over, and you could go back in and alter what you just did. By the way, in order to save it, you probably know how to save the PDFs here, but you just save that, and then I put it in whatever file I would like to put it in, and then I usually go into my Outlook and I attach it and I send it off to you, fine folks. Now, if you want to go back in and change it, and you can see it keeps track of the illustrations that you've done, you can also store them up here, saved illustrations and all of that good stuff. Of course, you can save what you just ran over here. If I wanted to save it, I could click there, and then it'll show up here when you later want to retrieve it. But if you want to change that I just did, maybe the columns were screwed up or the rows were screwed up, you can go back in and, I want to run it at $1,000 a month instead of $500 a month. So you just click up there, calculate, and then waiting. It will show you the same illustration except with double the premium. Let's see here. Boom. You look at that. And then you go down and you have double the premium there. So that is how you run an IUL illustration. And of course, this is for accumulation. If you're looking at it for death benefit, there are various other ways, but this is a #1 request that I got. So again, Charlie Gipple here. I hope this helped. If you have any questions, feel free to call my number there on the screen. My email is, you can email us at info@cgfinancialgroupllc.com. Thank you and have a good day.